Something massive has shifted beneath the global financial system, and most people did not even notice it happening because there were no emergency meetings, no dramatic press conferences, and no breaking news alerts flashing across screens. Just one quiet but consequential move by Japan that sent shock waves through markets around the world, prompting veteran market watcher Peter Grandich to issue a clear and serious warning that this is not noise, not routine volatility, and not a temporary market disturbance, but potentially the early stages of one of the largest financial unwinds in modern history, a process that does not announce itself loudly at the beginning but instead unfolds beneath the surface as long-standing assumptions begin to fail. For decades, Japan has acted as the silent engine behind global liquidity, playing a role very different from the one that captured most headlines. Because while the world focused on the United States Federal Reserve and the daily movements of Wall Street, Japan quietly held interest rates near zero year after year, a policy that was never meant to be permanent but ultimately became just that. And this single decision fueled trillions of dollars in global trades as cheap money flowed out of Japan and into stocks, bonds, real estate, and eventually even cryptocurrencies across the world, creating a system so familiar that most investors stopped questioning it altogether. Over time, this flow of near-free capital became embedded in the structure of global finance, supporting rising asset prices and reinforcing the belief that markets could absorb almost any shock. But now that system is beginning to crack as one policy shift and one change in direction are causing markets to react in ways that feel disconnected, unstable, and confusing, with currencies moving rapidly, bond markets showing signs of stress, and risk assets losing their balance. Developments that Peter Grandich argues are not random at all but deeply connected, because once an unwind of this nature begins, it rarely stops easily. This is not a crash yet, there are no circuit breakers being triggered and no headlines screaming collapse, but history shows that the most dangerous financial events do not start with panic. They start quietly when leverage begins to unwind and when cheap money is no longer cheap, and that is exactly what may be unfolding right now. To understand why this matters, it is essential to look beyond surface-level market moves and examine what Japan actually did, why it matters far beyond Asia, and how a single trade that most people have never heard of became one of the most powerful forces shaping global finance. Because this unwind does not only affect professional traders or distant markets, it reaches into United States equities, emerging economies, retirement accounts, and everyday savings. And according to Peter Grandich, it could mark the end of an era that defined global investing for more than a generation. For years, Japan followed a path no other major economy dared to take, keeping interest rates pinned near zero in an effort to fight deflation and keep its economy functioning. But the unintended consequence was that borrowing in Japan became extraordinarily cheap, creating a powerful incentive for global investors to borrow yen at minimal cost, convert it into other currencies, and invest that money into assets offering higher returns, a strategy known as the carry trade. What began as a seemingly straightforward way to capture the difference between low borrowing costs and higher yields evolved into one of the largest and most important trades in financial history, even though it remained largely invisible to the public, because Japan's role was silent but central. And as long as interest rates stayed near zero, the yen remained weak and volatility stayed low. The system held together, making investors feel safe and reinforcing the sense that risk was controlled. Trillions of dollars flowed through this mechanism as hedge funds used it to amplify returns, banks used it to support balance sheets, pension funds and institutions relied on it indirectly through global portfolios and structured products, and even investors who never touched the yen were exposed because asset prices everywhere reflected this constant stream of cheap money. The trade worked for so long because conditions appeared stable, central banks stepped in during market dips to restore confidence, and over time the carry trade stopped being viewed as a bet and instead became a background assumption built into strategies, models, and expectations across the financial system. The problem begins when the rules change, and Japan is no longer fully committed to endless cheap money, as inflation pressures, currency weakness, and rising global rates force policymakers to adjust, because even modest increases in borrowing costs matter when an entire structure has been built on the assumption that rates would stay near-zero indefinitely. As rates rise and the yen begins to strengthen, the math behind the trade flips, turning steady profits into growing pressure, making older loans more expensive to repay, shrinking the cost advantage that made the strategy attractive, and exposing leveraged positions to losses that can escalate quickly. At that point, investors are no longer rewarded for staying in the trade and are instead pushed to reduce exposure, a process that starts quietly with repositioning but grows more powerful because of its sheer scale, as those closing positions must buy yen to repay loans while selling the assets they previously invested in, setting off a mechanical chain reaction where yen's strength feeds on itself, asset prices come under pressure, liquidity tightens. And movements that once felt orderly become sharp and destabilizing. This unwind is not driven by fear but by structure. And Peter Grand's concern extends beyond Japan to the global system that has grown dependent on abundant liquidity. Because when one of the largest sources of that liquidity begins to retreat, the effects ripple outward into equities, bonds, real estate, emerging markets, and even digital assets, changing how capital behaves as investors become more selective, risk tolerance declines, correlations break down. And volatility increases. Large financial unwinds like this unfold over long periods, often in waves, because the size of the positions involved makes sudden exits impossible, leading to cycles of calm followed by stress as markets attempt to find a new balance. And while this instability can feel unsettling, it is not necessarily a sign of collapse but of transition as old assumptions are tested and replaced. For everyday individuals, these shifts show up through more volatile markets, tighter financial conditions, higher borrowing costs, and less predictable investment outcomes, reminding us that Japan's quiet role in providing the foundation for cheap global money shaped decades of financial behavior, and now that foundation is weakening. This is not about predicting doom, but about recognizing a structural shift, and understanding that the environment which shaped the last generation of investing is changing. Because awareness and comprehension of these mechanics allow people to adjust thoughtfully rather than reactively, and those who grasp the significance early are better positioned to navigate a world where the illusion of endlessly cheap money is fading, and the rules of global finance are being rewritten. It became one of the largest and most important trades in modern financial history, yet it remained almost completely invisible to the public eye, operating quietly in the background while reshaping global markets on a massive scale, because Japan's role was never loud or dramatic but instead silent and absolutely central, anchoring a system that depended on one core assumption, that interest rates would stay near zero and the yen would remain weak. As long as those conditions held, the entire structure stayed intact. Investors felt safe operating within it. Volatility remained subdued. Risk appeared controlled and predictable. The steady flow of cheap money pushed asset prices higher across the globe, reinforcing the belief that markets could absorb almost any shock without breaking. That sense of stability became deeply ingrained not because risks disappeared, but because they were masked by abundant liquidity. Now that direction is beginning to change. Japan is no longer fully committed to the idea of endless cheap money. Inflation pressures, prolonged currency weakness, and rising global interest rates have forced policymakers to adjust, and even the smallest shifts in Japan's policy send powerful signals because the system built on those policies is so vast. When borrowing costs rise even slightly, the underlying math changes in a way that cannot be ignored. When the yen strengthens, profits that once seemed reliable are replaced by losses. Positions that previously looked safe and effortless suddenly demand attention. Investors are no longer rewarded for remaining in the trade, and instead they are pressured to reduce exposure. This transition does not unfold all at once. It begins quietly with subtle adjustments, repositioning, and risk reviews, but because of the sheer scale involved, every move carries weight. What once supported global markets is now beginning to retreat, and that reversal sits at the center of everything that unfolds next. At the heart of this entire story is a strategy so simple that it almost sounds harmless on the surface. Borrow money where it is cheap, move that money to places where returns are higher, and keep the difference. This is known as the carry trade, and Japan became the perfect source for it. For years, borrowing yen cost almost nothing. Interest payments were minimal and in some cases nearly zero, turning the yen into the funding currency for the world. Investors did not borrow to spend, they borrowed to invest. Yen loans were converted into dollars, euros, and other currencies, then deployed into assets offering higher yields. This process repeated again and again, with profits reinvested, positions steadily expanding, and leverage increasing quietly in the background. What began as a smart and disciplined trade gradually evolved into a massive financial system. Trillions of dollars flowed through this strategy, shaping markets far beyond Japan's borders in ways that few outside professional circles fully understood. Hedge funds used it to amplify returns. Banks relied on it to support balance sheets. Pension funds and large institutions were exposed indirectly through global portfolios and structured products. Even investors who never borrowed yen were affected, because asset prices everywhere reflected this constant injection of cheap money. The trade worked for so long because the conditions supporting it remained remarkably stable. Japan held rates low year after year. The yen stayed weak. Volatility remained contained. As long as these pillars stood, risks appeared manageable. Losses were infrequent and short-lived. When markets stumbled, central banks stepped in, reinforcing confidence and validating the assumption that liquidity would always be available. Over time, this created a powerful sense of permanence. The carry trade stopped being viewed as a calculated risk and instead became a background assumption built into market behavior. Strategies were designed around it. Risk models assumed it would persist indefinitely. Global markets adapted to its presence, and a hidden giant grew quietly, supporting asset prices and encouraging risk-taking while remaining largely unseen by the broader public. The system begins to fracture when the rules change. Japan is no longer holding interest rates at the extreme lows that once defined its economic approach, and even modest increases matter because the entire structure was built on the belief that rates would remain near zero forever. As borrowing costs rise, the foundation of the trade weakens. At the same time, the yen begins to strengthen, a shift that may sound technical but carries real and immediate consequences. A stronger yen means loans taken out years earlier become more expensive to repay. What once produced steady, predictable profits now generates mounting pressure. The longer positions remain open, the greater the risk becomes. Borrowing is no longer cheap in the way it once was, and the cost advantage that made the strategy so attractive continues to shrink. For investors using leverage, this shift is particularly dangerous. Small market moves translate into disproportionately large losses. Risk managers intervene, margin requirements rise, liquidity tightens. Suddenly, holding the trade no longer makes sense, not because of panic or fear, but because the structural incentives that sustained it are fading, marking the beginning of a broader adjustment that reaches far beyond Japan itself. As a result, investors are forced to act not because of panic or headlines, but because the mechanics of the system leave them little choice, and that action begins with closing positions that no longer make sense under the new conditions. To unwind those positions, investors must buy yen to repay the loans they took out when borrowing was cheap, and at the same time they must sell the assets they originally invested in, reducing stock exposure, trimming bond holdings, and pulling back from riskier markets that once offered higher returns. This selling pressure is not emotional, it is structural, and that distinction matters because structural forces tend to reinforce themselves. As more investors buy yen, the currency strengthens further, increasing losses for those still holding positions. As more assets are sold, prices come under pressure, liquidity tightens, and moves that once felt gradual and manageable begin to feel sharp and unstable. This chain reaction is what is known as the unwind, and it is not a single dramatic event but a sequence of forced adjustments that spreads across markets as costs change and incentives shift. Peter Grand's concern extends far beyond Japan itself, because his warning is fundamentally about the architecture of the global financial system and how deeply it has come to rely on constant, abundant liquidity. For decades, markets have grown in an environment where money was easy to access, cheap to borrow, and reliably available whenever stress appeared, and Japan played a critical role in sustaining that environment. According to Grand, the shift now underway removes one of the largest and most consistent sources of global liquidity, and when that support weakens, the effects ripple outward everywhere. This is not confined to currency markets or any single region. It reaches into equities where valuations have been supported by low borrowing costs and steady inflows, and into bond markets where prices were bolstered by global demand for yield funded by cheap money. Real estate is exposed as well, because low rates made high prices affordable and encouraged leverage. And as liquidity pulls back, financing becomes tighter and price stability is tested. Even crypto markets feel the pressure, since much of the growth in digital assets occurred during periods of excess liquidity when investors were willing to take greater risks in pursuit of returns. Grand emphasizes that this shift fundamentally changes how capital behaves. When money is no longer abundant, investors become more selective, risk tolerance drops, and assets that once moved together begin to separate. Volatility rises not because markets are broken, but because the system is adjusting to less support. The era of easy money does not end with a single announcement or decision. It ends through a series of quiet reversals, and Japan's policy change accelerates that process. Liquidity is being pulled back not by choice but by necessity, and markets that were built on abundance must now operate under tighter conditions. As the unwind spreads, its effects do not remain contained within Japan or foreign exchange markets. The pressure moves outward, first hitting the largest financial centers. United States markets begin to feel the strain as global investors reduce exposure, and stocks that benefited from years of steady inflows face selling not because of deteriorating fundamentals, but because capital is being redirected to cover positions elsewhere. Bond markets react as yields shift in response to changing demand. Emerging markets are especially vulnerable since many rely heavily on foreign capital to support growth and stabilize currencies, and when global liquidity tightens, that capital retreats quickly, leading to falling asset prices and higher borrowing costs. Countries with large debt burdens or fragile financial systems experience the greatest stress. Currency volatility increases across the board as investors move funds and repay loans, causing exchange rates to swing more sharply, with moves that once took months now unfolding in days. This volatility complicates planning for businesses and governments alike, adding another layer of uncertainty to global trade and investment. In this environment, risk assets tend to suffer first, as assets dependent on optimism, leverage, and future growth come under pressure while investors seek stability. Positions are trimmed, exposure is reduced, liquidity becomes thinner, and price movements are amplified. At the same time, safe assets attract greater attention as investors prioritize preserving value over chasing returns, signaling a broader shift in mindset as the global financial system adjusts to tighter conditions. Events like this do not resolve in a single trading session. They unfold over time, reshaping markets gradually but persistently as the consequences of years of cheap money work their way through the system. Large financial unwinds move slowly, not because anyone chooses delay, but because they are driven by positioning, leverage, and the unavoidable need to adjust risk over time. And the sheer scale of the positions involved makes sudden exits impossible. Too many institutions, funds, and strategies are tied into the same structures, and every adjustment made by one participant directly affects the next, creating a chain reaction that unfolds in stages rather than moments. These unwinds happen in waves. One group reduces exposure, which pushes prices, yields, and currencies in a particular direction, and that movement then places pressure on another group whose risk limits, funding costs, or models are suddenly breached, forcing them to act as well. The process repeats not because of fear or emotion, but because of mechanics. Risk thresholds are hit, margin requirements change, funding costs rise, volatility assumptions update, models recalibrate. Each step logically leads to the next, and because of this, the timeline stretches out. It can take months for positions to fully unwind, and in some cases the process lasts years, especially when markets experience temporary stabilization before the next wave begins. Periods of calm are often followed by sudden spikes in volatility, creating a cycle of relief and stress that leaves participants uncertain about whether the worst has passed or is still ahead. During these transitions, markets become unstable in ways that feel unfamiliar. Price movements appear exaggerated. Correlations that once seemed reliable begin to break down. Assets that historically moved together start behaving differently, and investors struggle to interpret signals because the system itself is adjusting to a new balance. This instability is not a sign that markets are failing. It is a sign that they are changing, slowly adapting to a structure where old assumptions no longer apply. For the average person, these shifts show up in subtle but important ways. Markets become more volatile, with prices moving faster and reacting more sharply to news. Long stretches of steady gains are replaced by sudden drops followed by quick rebounds, making investing feel less predictable even in areas that once seemed stable. Financial conditions begin to tighten. Borrowing becomes more expensive. Credit becomes harder to access. Loan approvals take longer and terms become stricter, affecting everything from mortgages and car loans to business financing and job expansion. Decisions that once felt easy during periods of cheap money now require greater caution. Savings and retirement accounts are affected as well, as portfolios that relied on smooth growth experience larger swings in value. Diversification feels less effective when global markets move together during periods of stress, and assets that were widely viewed as low risk may no longer behave that way, surprising investors who assumed safety was guaranteed. Prices in everyday life reflect these changes too. Currency movements influence import costs. Higher financing expenses affect housing, durable goods, and consumer spending. Even when the connection is not obvious, shifts in global liquidity filter down into local economies, shaping costs, wages, and opportunities. The broader environment is changing. The assumptions that guided financial decisions for years are being tested. The rules that once seemed fixed are adjusting, and individuals are navigating a system that no longer offers the same guarantees it once did. For decades, Japan quietly provided the foundation for what became the era of cheap global money. Its policies allowed investors around the world to borrow at minimal cost, fueling growth across markets, real estate, and riskier assets, and that constant supply of liquidity became a hidden backbone supporting global finance, enabling strategies and trades that depended entirely on cheap borrowing. Now that backbone is weakening. Interest rates are rising. The yen is strengthening. Positions built on years of easy money are being reconsidered. The flow of funds that once felt endless is no longer guaranteed. This is not a sudden collapse or a dramatic financial panic. It is a structural shift, a moment that requires recognition that the environment shaping the last generation of investing is changing. Awareness becomes the most important tool. Understanding the mechanics behind these shifts allows investors and ordinary individuals alike to adjust before the full effects ripple through markets. Positions can be recalibrated. Risks can be reassessed. Decisions can be made with foresight rather than reaction. Those who grasp the significance early are better prepared to navigate changing liquidity conditions, anticipate volatility, and avoid being caught off guard by the ripple effects of a global system in the process of recalibration. The illusion of endlessly cheap money is fading, and recognizing that reality is the first step toward adapting to a world where the rules of finance are being rewritten, where stability looks different, risk is priced differently, and long-held assumptions must be questioned as the global unwind continues to unfold.